हेलो फ्रेंड्स, आज का मेरा वीडियो उन हीरोज को डेडिकेट किया जाता है जो इस इमरजेंसी सिचुएशन में भी फ्रंट रनर्स बनके अपनी जान की परवाह किए बिना हमें और हमारे देश को बचा रहे हैं, और वो है हमारी डॉक्टर्स। ये वीडियो डॉक्टर्स के लिए तो इंपॉर्टेंट है ही, इसके अलावा बाकी प्रोफेशनल्स के लिए भी इक्वली एप्लीकेबल है। सो इस वीडियो को एंड तक जरूर देखें और ज्यादा से ज्यादा शेयर करें। माय नेम इज नितेश अग्रवाल और आज का मेरा टॉपिक है tax saving tips for the lifesavers, the doctors. Like doctors always say, self-medicine is dangerous to health. In the same way, self-tax planning is also not advisable. Before starting the topic, let us see why doctors need a special advice on taxation. First, doctors go through a very busy schedule. They are not known to take usual breaks. And when they don't get enough time, how can they self-educate themselves on finance and taxation? Second, doctors have enough knowledge in their field, और जितना ही वो मेडिकल फील्ड में एक्सपर्ट होते हैं उतना ही नॉलेज शायद वो लैक करते हैं फाइनेंशियल रिलेटेड मैटर्स में, और इसलिए वो फाइनेंशियल रिलेटेड मैटर्स को अवॉइड करना भी स्टार्ट करते हैं। थर्ड, when we ask from the doctor from whom they take financial advices, the reply which we receive is the relatives, friends, co-doctors, and sometimes even their patients. They easily believe on anyone who looks like having some knowledge, and they rarely cross-verify the advices from others and eventually end up paying enough taxes. Fourth, doctors earn quite well and they have a very big goal, but they are not a good investor. It is often seen that they keep huge amount of idle funds in their bank account, not knowing exactly what to do with them. Fifth, when it comes to starting a career, doctors are at a disadvantage. While most of us settle down into our first jobs in early 20s, medical practitioners start earning when they are almost 30 or above because of long training period. Starting out late and long erratic working hours do influence doctors' financial life. They don't have much time to concentrate on planning their finances. Let us now discuss some very interesting tax saving secrets. Tip number 1. Section 44 ADA Presumptive Taxation Scheme. When you opt for presumptive taxation, your income is presumed. Actual profit is not calculated. You can assume your profits to be 50% of your total receipts. However, only those who have annual receipts of rupees 50 lakh or less can opt for this scheme. If your annual receipts exceed rupees 50 lakh, you must report them and deduct actual business expenses to compute profit. Those who opt for presumptive taxes do not have to compute or report actual profits. Presumptive taxation for doctors was introduced with effect from financial year 2016-17. This scheme is available to individuals and HUFs. If you are incorporated as a company, your profits cannot be presumptive. Also, you must be resident in India as per the Income Tax Act. If you opt for this scheme, you do not have to keep books of accounts and no audit is required. This will help you to save approx rupees 20,000 easily that you would have to pay as a fees to an accountant or an auditor. But it may be wise to keep at least some records of the transactions of your profession. You are also not required to pay advance tax in installments. Paying your entire tax dues by 15th March of the financial year will suffice. Tip number 2. Grow your wealth using Section 54. This section actually makes you rich. How does it make you rich? Now, it is a very well-known secret that you save tax when you buy a house. How can we do that? If I were to tell you, technically say under Section 24 of the Income Tax Act, you are getting tax deduction of the EMI paid for the house. Your interest on housing loan along with the principal amount is allowed as a tax break, meaning income to that extent is reduced. So your income minus your EMI, whatever is left, you pay a tax on that. So this is a very well known to you. But then what is Section 54 and how does it help you to grow your wealth? Let me tell you friends, the problem does not arise when you buy a house. or you have a housing loan and you pay your EMI regularly. What happens is the day you decide to sell this house. First of all, we insist you to hold it for 3 years so that you go into long-term capital gain bracket. After you cross the 3 years barrier, when you go to sell this house, let's say you have purchased a house for 1 crore and holding it for 5 years, now you are able to sell it at say 2 crore. The challenge comes that the difference between 2 crore and 1 crore, that is 1 crore which is a profit, is taxable, and it is taxable at a flat 20%. So out of the 1 crore profit that you gained, government is saying, give me my share 20 lakh. How do we save that? Is there a legal way? Yes, there is. All you got to do is utilize section 54. What does section 54 says? Section 54 says that whenever you sell a house, the profit from that house have to be reinvested in another property. So if you sold a house for 2 crores and the profit is 1 crore, you can keep your original 1 crore with you and do whatever you want to do with it. But the profit 1 crore has to be reinvested in either buying a house within the 2 years from the date of sale of original house, or you have to make or construct a house within 3 years from the date of sale of first house. Now people who continuously does this every 4-5 years have accumulated so much wealth that they can easily retire on any island. Tip number 3, section 80C, investment in tax saving instruments. Every year you are allowed to save some money and invest it somewhere and get a tax deduction on that. The section is known as section 80C. So under section 80C, there are 7 to 8 investment options in which you can put money and walk with a tax break. So whatever money you put in there, subject to ceiling limit at present, which is 1,50,000. So again, income minus your investment will only be taxable. If you are young and can keep your funds for a long term, I would suggest you to go for ELSS, equity linked savings scheme. Again, there is lock-in period of 3 years. This is a kind of mutual fund which is created specifically for saving tax. The rate of return is generally much higher in it compared to other instruments. You put money in mutual fund if it performs very well, and even if it doesn't perform very well, whatever amount you have put in it is deductible from your income and helps you to reduce tax. So there's a double benefit. Tip number 4, make use of an HUF. One important way of saving income tax is to think of forming a separate legal entity in the name of Hindu undivided family. Please note that this is a separate legal entity which is officially recognized and approved under the income tax law. The creation of Hindu undivided family helps the taxpayer to save their taxes in a legal manner. There is a myth that only businessmen can take the advantage of HUF. Believe me, doctors and other professionals can also form an HUF and take its advantage. Suppose in a family there are 2 doctors and they run a clinic. They can very smartly form an HUF and transfer their professional income in that HUF. The tax slab which is applied to you as an individual, the same is also applied to an HUF. Again, individuals can also transfer their incomes like rental and interest income to their HUFs, which is often seen taking your total individual income to a higher tax bracket. So in this way, they can smartly balance their income and reduce their overall taxes. According to the current income tax law, if an individual owns more than one house property, he is allowed to claim only one of them as his self-occupied property. The others will be considered as deemed to be let out, and you are required to pay tax on notional rent. But an HUF can also own a residential property without paying taxes for it. It is also eligible to purchase a house by taking a home loan and can enjoy deductions relating to that loan under section 80C and 24. Apart from getting tax deduction up to rupees 1,50,000 for an individual, it is possible that if an HUF is created by that individual, he will be able to claim higher tax deduction, rebates, exemptions under the income tax law. The new tax entity in the form of HUF will be eligible to claim separate deductions under section 80C, 80D, 87, etc. Likewise, the dividend income and the long-term capital gain on listed securities would also be exempted for such HUF. The income from short-term capital gain by this HUF will also be eligible to a lower tax rate of 15% only. So friends, these were some very interesting legal ways of saving tax, specifically for the doctors. We'll come with more such videos relating to tax saving and growing wealth. Till then, goodbye.